me. Great to be here. So today I'd like to talk to you about a couple of things. First off, I'd like to talk to you about the investment philosophy and process that we follow at 3G Capital. And second, I'd like to talk to you about how we put theory to practice. I'm going to tell you about an example of how we apply our investment philosophy and process to real-life investment cases. So first off, some background on 3G Capital. 3G Capital is a private investment partnership that invests in undervalued securities around the world. Our investment universe includes emerging, frontier, and developed markets. Essentially, we look to buy at single-digit multiples a small collection of industry-leading businesses. What we basically look for is good businesses managed by good managers and available at a good price. The 3Gs basically, and hence the name of the firm, 3G Capital. We've been in business for about 20 years, and in the course of our existence, we generated a track record of significant outperformance versus the index. So you can see that we almost doubled the performance of the underlying index. So now let's talk about our investment philosophy and process. So the cornerstone of our investment philosophy, like I said, is focusing on the 3Gs: good business, good management, and good price. So let's review each one of them in more detail. First off, good business. What's our definition of a quality business? For us, a quality business always necessarily starts with a sustainable competitive advantage. As such, we normally look to buy businesses that are industry leaders in industries that are easy to understand. We stick with industries that exhibit something that we call leadership sustainability, a dynamic whereby industry leaders, number ones and number twos, tend to stay in the lead for many, many years, many decades actually. And we also have to be able to easily understand the factors behind that leadership sustainability, and we should be able to easily predict as to whether those factors are going to persist in the future. When we look at industries, we generally prefer to stick with highly fragmented industries because anytime you deal with a fragmented industry, you create this growth potential situation as industry leaders can consolidate those markets at the expense of weaker players over time. In terms of quantitative metrics, we define good businesses as businesses that generate returns on equity over at least 15% plus, and they would normally employ very little debt while generating those ROEs. More specifically, we're looking for businesses that have debt payback ratios of less than 3 to 5 years. As a practical matter, if you were to look at our portfolio today, what you would see is that 75% of our portfolio holdings are actually debt-free. They have excess cash on their balance sheets, and the remaining quarter have debt, but it's limited to a 3-year debt payback. Next, let's review our definition of good management. So when it comes to good management, there are a few things that we look for. First of all, we want management teams that are skillful operators. We want management teams that are also capable of capital allocators. So how we do it, we basically carefully examine the track records of operational excellence of management teams, and we study both quantitative and qualitative metrics to conclude whether the management passes the test. To give you an example, on the quantitative front, we would look at things such as margins, growth rates, market shares, etc., just to see how management has done operationally. But it doesn't end there. We're going to look at qualitative metrics as well, which is also very important. And when it comes to qualitative metrics, what we want to do, we want to examine managerial decision making over time at critical junctions. I can digress a bit and talk about a specific example. So there's this one company that we own called CAVIE, which is a super app out of Kazakhstan. And that business is very unique because how they evaluate their products is based on NPS scores. So they don't have profitability targets, volume targets, or anything of that nature. It's purely NPS scores. And so they had this one product that was very successful for them, and it contributed about 50% of their EBIT. And that product was a credit card product. And what they discovered is that that product consistently had negative NPS scores. And what the management said, they said, listen, with this business, we realize that we'll never be able to get that business to be a positive NPS score because just the nature of the credit card business is such that people are always getting pissed at something. And they basically said, look, our entire DNA is creating products that are NPS positive, and therefore we're just going to shut it down. It took them 24 hours to make the decision, so they got rid of a business that contributed half of their profitability, just like that. So, which was totally unconventional, flew in the face of conventional wisdom. However, it was the right decision to make because their judgment was as follows. They said, look, if we stick with this product, what's going to happen is that, yes, we are going to preserve half our EBIT in the short term, but we'll lose the entire business long term because this business runs contrary to our philosophy and is going to corrupt the business, and we eventually going to lose it all. And therefore they said, look, we're better off just losing half the business in the short term, but preserving our DNA. And that was the right decision to make. So next, like I said, in addition to having skillful operators, we want capable capital allocators. And with that, we study the track record of what management does with free cash flow. Of course, we want management teams to reinvest back in the core business to the extent that they can do it profitably. However, we also want management teams that can acknowledge that once they're unable to allocate profitably the cash that the business generates, they're happy to return it back to the shareholders in the form of either dividends or share buybacks, provided those buybacks can be done at an attractive valuation. Then we also look for proper alignment of incentives. We look for compensation structures that create bonuses and salaries to shareholder value creation. And lastly, we want management teams to have skin in the game. So it could be explicit or implicit. Explicit would be, let's say a management team that owns 30% stake in the business. Or you could have an implicit skin in the game, which would be perhaps a founder who is just emotionally attached to the business, and perhaps he does not have much ownership, but he still feels like he needs to make it a success. And one such example would be Steve Jobs. Like, he didn't have much of an equity stake in Apple, but when he came back, he had his ego invested in the business, so he wanted to make sure that he leaves a mark. Finally, the easiest piece of our investment philosophy framework is good price. We normally look to buy businesses at anywhere between 4 to 10 times normalized sustainable earnings. The exact multiple that we pay depends on the business profitability and growth profile. One thing I'd like to emphasize is that we look for normalized sustainable earnings rather than current period earnings when coming up with a valuation. And basically we just adjust the earnings to reflect mid-cycle figures rather than either down market figures or up market figures. And of course, we make sure that to the extent that there are any items that are one-times in nature, we exclude them from the analysis. And as a practical matter, if you were to look at our portfolio today, what you see is that our average earnings multiple for the portfolio is about 6 times. The dividend yield is about 7%. And that compares to MSCI XUS earnings multiple of 16% and a dividend yield of 3%. Now let's talk about our portfolio construction. Our portfolio is long only and generally unlevered. The reason is this provides additional protection from permanent loss of capital. We typically target to hold about 10 to 12 positions, with the average position at a 10% weight. Top 5 would normally comprise about 60 to 70% of the total. The Maximum position for us would be 25%. The minimum would be 5%. The reason for the 25% limit is that no matter how confident we can be in a specific investment, we just want to be sure that if we do make a mistake, it does not derail the whole portfolio. And the reason that we have a minimum weighted requirement of 5% is because if we're not confident enough to put at least 5% in a business, that tells me that we shouldn't be even invested in this business at all to begin with. Our average holding period is expected to be about 3 to 5 years on average. And when it comes to sell discipline, there are 3 cases in which we would sell a stock. Number 1, we would sell a stock if the price reaches intrinsic value. We could sell a stock if better investment opportunities become available, or we could also sell a stock if the original characteristics of the security, such as business quality or management quality, are no longer present. Let's review our research process here. There are 2 elements to it. There's a qualitative element, and there's also a quantitative element. So let's review both. We can start with qualitative. So one thing that you know, looking at our research process, that it's really research intensive due to the fact that we have this private equity orientation and we approach investing with a private equity mindset. Our approach is to become local experts in whatever market we're investing in. So we use this extensive network of on-the-ground intelligence gathering so that we gain unique insights into businesses around different countries. We regularly speak with suppliers, customers, competitors, industry insiders related to different businesses in different industries around the world. And in the process, we get to know management either through local sources or in person, and we carefully examine the track record of their performance by using our on-the-ground intelligence gathering network. One thing of note is that we have this multi-geographic approach such that we study industries across a number of different countries, and I think that gives us a good advantage versus local-only managers. I think we can develop a better sense of analytical perspective if we can do that. Just, a real-life example, we studied banking systems in places such as the US, Brazil, Russia, Canada, and that made it a lot easier for us to understand banking systems in other places in the world, such as Turkey or China. On to the quantitative element of our research process. What we do specifically, we examine financial statements. We go back 10 to 20 years to get a sense of where the business is quantitatively. We consider things such as margins, returns on capital, cash flow generation versus cash flow uses, growth rates, debt levels, a number of different industry-specific metrics. And once we do that, we then proceed to compare those metrics versus historical levels, versus peer levels, and versus theoretical levels implied by the business's competitive position. So once we're through with this process, we basically put together a basic go-forward model. And with that, we basically focus on normalized sustainable figures. We adjust those figures to reflect mid-cycle numbers. We exclude all the items that are one-time in nature. And of course, we try to be very conservative at each step of the process. And the final step in our quantitative research element is to compare the attractiveness of the business from a quantitative standpoint to all other investors that we have on the potential investments list. And we also compare the potential return from an investment against our hurdle rate of 15%. The final element of our investment process is risk management. We define risk as a permanent loss of capital rather than short-term stock market fluctuations. So what we do first, we try to establish a range for intrinsic values for a given asset. And I'd like to emphasize that anytime you look at an asset and you try to estimate intrinsic value, it's never a fixed number, it's a range. So once we come up with a range of intrinsic values for a given asset, what we do would then proceed to try to buy it at a significant discount to the lower boundary of the range. And if you do it this way, you just realize that there is no such thing as risky assets. It's actually all about risky prices. Normally people would say that such and such asset is risky because you have a wide dispersion of potential intrinsic values, and so it's not a good purchase. To that we would respond that of course the wide dispersion of potential intrinsic values could be wide, but to the extent that you buy an asset at a discount to the lower boundary of the range, then it's still a low risk purchase. So it's really all about the price. When it comes to risk management techniques, we use several of them. We look to buy easy to understand businesses at substantial discounts to value. We use position limits. We use country and industry limits. We also monitor consistently the correlation between stocks within the portfolio. And finally, we use leverage only sparsely, and in any event, we make sure that anytime we do use leverage, it is capped at the number consistent with the dividend yield for the portfolio, so that we know that we can always pay down through cash flows that we generate through dividends. And of course, we constantly monitor the gap between prices and values for our portfolio so that we're protected at all times. So that concludes the theoretical part of our discussion today. And now let's talk about putting theory to practice. So here's the real-life example. I'd like to talk to you about a company called Genomma Lab International. So Genomma Lab International is a company based in Mexico City, Mexico. It's one of the largest personal care and OTC pharmaceutical products company in Latin America. The company's brands occupy leading positions across their respective categories. The company is present in 18 countries, primarily Latin America. And the income split for the business is 50-50 between OTC pharma and personal care. The company derives 40% of revenues in Mexico, 50% in the rest of Latin America, and 10% in the US. So the valuation at purchase for this business was 5.5 times earnings, and it was a 6.5% dividend yield. So, by way of background, here's the product lineup. On the personal care side, these are the products that the company makes: skin care, hair care, beauty care. When it comes to OTC pharma, they sell things such as cough and cold medicine, anti-flu, pain relief. So basically the equivalent of Tylenol and Advil here in Canada. If you were to go to a retail store, a pharmacy, or supermarket in Latin America, this is where you find the company's products. They occupy premium shelf space in those retail outlets. Here are the production facilities. This is where the magic happens. So you got both production and distribution integrated here in Toluca, Mexico, which is about 1 hour away from Mexico City. I don't know if you can recognize me in the picture on the upper right. I'm wearing a mask, so. But those facilities are state-of-the-art, highly automated. When I visited the facilities, I was really impressed to find out that they felt totally empty. And at any given time, and it's a huge facility, like it's a facility that equal in size to probably 5 or 6 football fields. At any given time, you have probably no more than 12 people at the facility. So it's all done by robots. So now let's examine Genomma Lab. by applying our 3G framework and see how it fits within that framework. So is Genomma Lab a quality business? Well, let's go through the data here. Like I said before, for us, the number one thing when it comes to business quality is a business that has a strong competitive position. And if you look at Genomma and you ask yourself a question, do they possess that? I think the answer is yes. If you look at the company brands, what you're going to see is that they occupy number 1, number 2, or number 3 positions across the respective market segments in Latin America. So for the company, brand name and distribution power are the 2 factors that create competitive advantage for the business. When it comes to the company's brand power, it's consistently reinforced across both traditional and digital media. Genomma Lab is number 1 TV advertiser in Latin America, the number 1 multimedia content producer in Latin America, and they're also number 1 in digital awareness in Latin America. If you were to talk to their competitors, which I have, such as, for example, Pfizer or Procter, and you ask them, well, who is the competitor that you hate the most? They all invariably say the same thing, Genomma Lab. Why is that? Because they're just so much more nimble when it comes to bringing product to market. For Procter to bring product to market in terms of marketing campaign takes between 9 to 12 months. For Genomma Lab, it takes 3 to 4 weeks. So they're super quick. They're running circles around those big guys. And there is nothing that Procter can do. So in addition to brand power and operational agility, Genomma Lab possesses another advantage, which is the distribution network. They sell their products across 500,000 products of sales in Latin America, and 80% of those POS points are serviced on a DSD basis. So for someone to come in and challenge Genomma by replicating the brand power and the distribution reach would probably cost well north of 50 billion pesos. And if you look at the market cap for the company, I think it's about 20. So I don't think a challenger would ever do it. They would just say, you know what, like I'll just pay 100% premium and just buy out Genomma. I'm not going to spend 60 billion pesos on recreating the brand power and distribution. And of course, you know, there is no coincidence that if you were to study the industry, the history of the fast-moving consumer goods industry around the world, you'd find that industry leaders such as Procter, Colgate, Unilever, etc., that they've all been in the lead for many, many decades, and that's precisely why, because that's the dynamic. Once you have the brand power and distribution reach in that business and fast-moving consumer goods, it's very hard to dislodge it. So let's examine the business quality from a quantitative perspective here. As you would expect, given the competitive advantages that the business has, the outcome of that leads to superior economics. Genomma Lab is able to generate high returns on equity while employing very little debt. The returns on tangible book for Genomma are over 30%. The margins are close to 20% with minimal capex. The go-forward margins might actually be even higher than that as the company puts on stream new manufacturing facilities. Lastly, the debt payback for the company is about 2 years, and the company has a debt rating of AA+ from Fitch. It is likely that the company's impressive economics will persist into the future. As I told you before, if you were to study the history of the fast-moving consumer goods industry, what you see is the dynamic of leadership sustainability. Industry leaders in that industry tend to stay in the leads for decades. In addition to impressive economics, the company has decent growth potential. The company's end markets are large and growing, and so they have a double benefit of growth. Number one, they're likely to grow with the markets as those markets expand. And number two, they're going to grow within the markets because they should be able to consolidate those markets using the leadership position at the expense of weaker players over time. Now let's review management quality at Genomma. So let's first look at operational skill of the management. So by way of background, the current management team has been at the helm since 2014. So prior to that, the business fell in hard times because they had lack of institutional infrastructure and they did not have industry-specific expertise. So the new team that came on board in 2014, they actually had decades of expertise accumulated across companies such as Procter, PepsiCo, L'Oreal, and McKinsey. So when they came on board, they wasted no time putting the business back on track. And of course, the track record that they have is nothing short of phenomenal. If you look at the metrics in 2014, the business lost about 70 million pesos on 11 billion in sales. This year, the business is expected to generate over 3.6 billion pesos on over 18 billion in revenues. How did the management do it? Well, they did a few things. Number one, they put the resources behind the best and the biggest brands. They reduced costs substantially, and they optimized working capital management by reducing working capital. In addition to being skillful operators, the management Genomma are also capable capital allocators. Of course, for them, the first order of priority is to reinvest back in the business to the extent that they are able to improve the profitability and the competitive standing of the business. And a recent example would be the company insourcing manufacturing to improve their supply chain over the past 3 or 4 years. As a result of the project, the company managed to improve profitability, improve cash flows as a result of working capital reduction, and they also managed to improve customer service with that because now they have better supply chain visibility. Of course, it's not a capital-intensive business, so even after you reinvest back in the business, there is plenty of cash left over. And management is very generous to the shareholders with that. They basically take cash flow in its entirety and they send it back to the shareholders in the form of dividends and share buybacks. And they have a very impressive system of assessing whether to do buybacks or make acquisitions. They're going to look at the multiples, and they're going to say, look, to the extent that our business is selling, for example, for 1x EV to sales, and acquisition multiples in Latin America are 4x EV to sales, we're just going to buy back our own stock. But of course, if at some point they can make an acquisition at 1x EV to sales and their own stock is selling at, let's say, 2x EV to sales, they're probably going to be doing acquisitions. But it's very logical approach, very rational approach that they have with respect to capital allocation. And finally, on the topic of shareholder alignment, the interests of management and the shareholders are very well aligned. The company's chairman founder, Rodrigo Herrera, owns about 30% of the business, and so you can tell that he's definitely walking in shareholder shoes. And finally, let's examine the third element of the 3G equation, which is price. So the multiple, the earnings multiple for Genomma Lab was about 5.5 times at purchase, and it had a dividend yield of 6.5%. EV to sales at that time was less than 1. Now, if you look at the company's own historical multiple, it was about 15 times. If you look at the publicly traded global peers, that multiple is 20. If you look at the market, it trades at 18 times. And if you look at private market buyout multiples in Latin America for fast-moving consumer goods companies, they averaged about 4 times in the past 10 years. So I think it's pretty obvious looking at those numbers that however you slice it, Genomma Lab is significantly undervalued. Of course, no discussion of an investment case is ever complete without discussing the risk factors. There are a few risk factors here. Number one, there is a risk that there is an economic slowdown in one or all of the company's market at some point. The good thing when it comes to Genomma is that the company's products enjoy low price elasticity so that the company can maintain a degree of revenue stability even during weak economic times. Second, currency risk. Here, again, the company is fortunate because its products are essential low-ticket items, so it has no problem raising prices to more than compensate for any local currency depreciation. And this is not just theoretical. A recent example would be Argentina. I think the Argentine currency got cut in half recently, and Genomma Lab had no problem at all raising their prices in Argentina by more than 100%. So they more than compensated for local currency depreciation, therefore their price in hard currency actually went up. And if you look at the segment information for Genomma, it so happens that Argentina now is their most profitable market. Third, corporate governance. There are a few factors here that were studied to see if there is an issue with corporate governance. First of all, we look to see if the company is operating economics to the full extent. So how we do that, we look at the business and its competitive position, and we just say, look, given the competitive standing of the company, is profitability that the business shows consistent with the competitive position of the business? And in case of Genomma, the profitability seems to be consistent with the competitive position of the company, so there don't seem to be any leaks from an operational standpoint to third party. We do the same analysis when we look at capital allocation when it comes to corporate governance assessment. We also look at what the company does with cash flow. Again, we try to see if there are any leaks to in favor of third parties when it comes to capital allocation. Again, here looks pretty clean. 100% of cash flow goes back to the shareholders via dividend and buybacks. So no issues here. And finally, if you look at the alignment of interest with respect to the chairman founder, again, looks very clean from that perspective as well, because Rodrigo Herrera was the guy who actually instituted that major strategic pivot back in 2014 to build out institutional infrastructure, and he brought on board people with industry-specific expertise that created a lot of value for the shareholders. So it seems that the corporate governance risk in this case is fairly low as well. Lastly, geopolitical risk. If you look at Mexico, it appears to be firmly in the U.S. geopolitical orbit. So I would say that the risk of a major geopolitical conflict such that would lock out U.S. investors out of the Mexican market is very low. So let's examine the decision-making process and outcome. We proceeded to buy Genomma Lab last year as it cleared the 3G checklist. We sized the position to our target model weight of 10%. A couple of reasons for that. Number one, as we examined the metrics for Genomma Lab, they didn't really deviate from our model metrics by too much, either on the upside or the downside. And we did not notice any correlations between Genomma Lab and other stocks in our portfolio, either from an industry or a country standpoint. So performance since purchase last year, the stock went up 30%. Management has delivered on their promises to improve profitability, and so even though the stock increased, the business still remains significantly undervalued at 7 times earnings and a 4.5% dividend yield. And so our action at this time with respect to Genomma Lab is to hold. So that concludes my presentation, and now I'm happy to take whatever questions you might have.
So this company started as a family business? It started as a family
yeah,
business?
it started as a family business, right?
And how old is the company? How old is it?
I believe it started in 1984.
And then the founder said, I don't have the skills to manage this company, so I'm bringing professionals.
Right. What happened is, like you said, it was a family business. So, like, the guy is a marketing maverick, but like he's not good when it comes to things such as financial management and operational excellence. And he hired a bunch of relatives to help him with that, and of course, you know, they failed miserably. But he was smart enough to realize that. So, in 2014, he basically just fired those people and just said, look, you know, we're gonna run it as a professional business, not as a family business. And he hired a bunch of people from Procter, PepsiCo, McKinsey, L'Oreal, and those people, they provided the sort of the industry-specific expertise, and they managed to develop the institutional-grade infrastructure for the business.
So these were like Mexicans, or they brought from the US?
No, no, not from the US. Some of them were Mexicans, some of them were Argentinians, some of them were Colombians. But basically, all of those guys, like I think that CEO at the time, Jorge Brave, he was, prior to Genomma Lab, he was the head for Procter & Gamble in Latin America. So, like...
So how did you find this company?
You know, we're just reading a lot. Like, we actually, I think, discovered this business about 10 years ago. So I was just kind of on my screen for a long time. I followed the story. I always knew, like, well, you know, even when I saw it, like, 2010, I said, look, good business at the core, but management was not so good. They didn't run it right. It wasn't institutional enough, and they had tons of debt. So I'm like, look, let's just see what happens. And then over time, I noticed them making significant progress. They brought in a new management team. You know, they started improving profitability. They started paying down debt. Then they started paying a dividend. So things have gradually gotten better for them. And also just, you know, at some point, for some reason, the stock price just collapsed, like for no good reason. Perhaps people were concerned about the Argentina exposure or something. And after over 10 years of waiting, we just pulled the trigger.
Because you find companies from around the world in emerging markets, and how do you start? You start with a database that you look roughly and then you narrow down, or how do you do it? How do you?
No, it's not a database. Basically, like, we pick up a stock manual, for example, for Mexico, and we just go from A to Z down the list. And we just try to draw circles around the businesses that are potentially interesting. And there are not that many of them, so it takes me probably 10, 20 seconds to decide if I even want to put it on the list, and then you come up with a short list of maybe 20, 30 names, and over time, and I've been in this business for, you know, over 25 years, then over time you just built up a good database of knowledge about those businesses. But yeah, it's basically just, you know, you pick up a stock manual for a given country and just go through it A to Z.
Like, you know, when we met with Buffett one time, we said, you know, how do you buy the stock? And he said, I look in the value line, and I hit through the value line, and I said, hey, this looks like a good stock to buy.
Yeah, it's not that different. Like, that's the process. That's the process. Because I can tell you that, for example, like with Turkey, if you were to look, well, it's not value line, it's something else. It's a different name in Turkey. But, you know, you're going to go through a list and you're going to come up with maybe, I don't know, 10, 15 names that are even potential of interest. Maybe the price is not going to be the right price, but at least you're going to say with respect to business quality and management quality, like those are good. So then you're going to go through the entire research process on those names, and by the time that stock price becomes attractive at some point, you already did your homework, so you know that you can pull the trigger very quickly.
Okay, questions?
So on Tuesday, we had Lawrence Steinberg come by from Steinberg Management, and he said he was in Mexico back in '89, and was almost ready to invest. And then he talked to folks on the ground, and they told him that, listen, different accounting regime, you need boots on the ground, you need the depth of knowledge And we just saw that Dr. Claudia Schaumburg now, I think the new president there, potential changes politically, like how do you manage that risk when you are sort of here and you're going into a country with so many different potential geopolitical risks as well?
Well, it's kind of interesting that if you talk to someone in Mexico, they don't perceive their country as being risky. But to them, they're going to say, well, Canada is very risky. So it's...
I'm sure the Turks will say the same, but
yeah, the Turks will say the
here,
same.
how will you make sure that you don't, get downside exposure just because you are so far away and you're going to boots on the ground to know what's going on?
Well, and that goes back to, I guess, that first slide that I had. Let's see. Here, research process, qualitative. So we actually have an extensive on-the-ground network around the world, and that network helps us develop unique insights into businesses locally. You're right, if you think that you can just sit here in Toronto and just purely do desktop research on businesses in China or Mexico, Brazil, it just does not work. Because there's so many things that don't meet your eye. On the surface, it all might look good, but once you go beneath the surface, then it could be a totally different thing. And to go beneath the surface, you need those local sources. And we basically cultivate those sources that we've been cultivating them for decades. And that's what we use to back up our research process. But back to Mexico, one thing I'd say is it's not that far. It's a 4-hour flight, so I've been there a few times. So yeah, and I think specifically with respect to Genomma Lab, it's legit when you talk to Pfizer in Mexico. You talk to I talked to this girl who runs Pfizer marketing in Mexico, and I talk to people at Procter in Mexico. If they tell you that we hate Genomma because they're so successful we cannot beat them, well, that tells you that it's unlikely to be a fraud, so it's probably a real thing. But it just, that's the way the rest of it is.
Thank you very much for your presentation. I have two questions. One is, you've been in the business and managing for over 25 years. So you definitely rode through the 2008 global financial crisis, 2020 COVID, and maybe the last few years with Ukraine and everything. My first question would be, what are your tips when it comes to when we have a very down market and markets crash? How do you retain your clients? How do you communicate with them such that they can have a conviction to stay with you or maybe even invest more? That would be my first question. And second one would be, has anything changed since with the Ukraine invasion? There's definitely a lot that are happening geopolitically and likely going forward as well. So has any of your decision framework or the country risk exposure rate or anything of that changed? Where are you finding opportunities today?
So let me start with the last one. So of course, geopolitically things are challenging, but I think they've always been challenging. For a short period post Soviet collapse. So the way we address it, we make sure that we have strict position limits, and we study specific countries that we invest in. And we're not going to be making a moral judgment, but what we're going to be doing, we're going to be saying, look, if there is a conflict, how likely is the conflict, and to the extent that it happens, what happens to our investments. So that's why, if we're to invest in Germany, for example, or the UK, we don't mind having a large portion of the portfolio in those places because it's unlikely that you're going to have a geopolitical conflict between the US and Germany to such an extent that you're locked out, kind of like you guys locked out of Russia. And actually the same thing goes for Mexico. So I just don't think there's going to be a geopolitical conflict between the US and Mexico to such an extent that you're going to be locked out of the Mexican market. Of course, once you talk about other places in the world, such as China, it's a little different. Although I'd say the risk of geopolitical conflict with China has always been lower than that of Russia, because I think China is fairly strong and it's a very important country in terms of global GDP. So it's just a much harder decision to go, initiate a conflict with China. So again, could happen, but not a very high probability. When it comes to Russia, like I kind of thought that there was actually a very significant likelihood of conflict between Russia and the West, because Russia is very weak compared to the West. So that weakness is just always inviting conflict. So for that reason, we didn't really have any investments in Russia. I suppose if something was attractive, you'd buy some, but you wouldn't buy much for that very reason. And so that's to answer the question about the geopolitical situation. And what was the first one?
How you communicate with clients when there's a down market?
Well, I think the key is to communicate to them well before there's a down market. So even during the initial stages of our conversations with potential clients, we tell them, listen, don't expect smooth returns. There's going to be volatility, sometimes significant volatility. We run a 10-stock portfolio, so if you're not comfortable with it, don't invest. But we also tell them, look, if you invest with us, it's not about pieces of paper whose price wiggles around daily. It's about specific businesses. So what I would tell them, look, here's what you own. If you buy into 3G Capital, you're going to be owning a piece of Genomma Lab. If you own this business outright, are you going to be worried about stock market turmoil? No. Like it's business, like they sell pain relief products, they sell shampoos, they're going to sell day in and day out. People need shampoos. So why do you need to worry about it? Just because of the stock price volatility. So I think in using those examples, that gets the point across, hopefully.
Do you issue like special letters during COVID, anything of that sort? Did client reach out to you a lot, call you, and you had to give a really good few examples of your business or anything of that sort?
No, we actually have a client base that's up to speed on how we do things. So they, for the most part, they didn't really need any additional communication, but we're always available. If somebody wants to reach out to us, we're happy to just take them through it, just go position by position, explain the rationale so that they see that they own specific businesses, that they own shampoo manufacturing business. They don't just own a piece of paper.
Thank you very much.
May I know top 3 stocks in largest position in 3G Capital?
Sorry, can you speak up, please?
The top 3 holdings for 3G Capital?
The top 3 holdings.
Oh, the top 3 holdings? That's where my mouth is not connected to my brain. But I can talk about one holding. One of the top 3 holdings is a company called CAVIE. CAVIE is a super app out of Kazakhstan. So the best way to describe it would be if you live in Kazakhstan, if you wanted to get your passport, you wanted to get your driver's license, you wanted to pay your bills, you wanted to transfer money to your friends, you want to buy groceries, you want to buy television, you want to buy toothpaste, you want to buy shampoo, you want to get a loan to buy all of those things, you want to buy a car, you want to sell a car, you want to buy train tickets, airline tickets, you do it all with CAVIE. So CAVIE is very much your window to the world. So it's indispensable. And it's a unique business because they have a management team that is absolutely phenomenal. Just to give you a couple of examples, before CAVIE, MasterCard and Visa were the number 1 and number 2 payment providers in Kazakhstan. That was prior to 18. And even Buffett says that companies such as MasterCard and Visa, they're unassailable. Well, CAVIE got into the business, and within 2 years, they reduced MasterCard and Visa to probably 12% of the market. So they did something that even Buffett said was impossible to do. And they did it more than once. If you look at CAVIE, they were not in e-commerce prior to 13. And Alibaba was the number 1 player in e-commerce in Kazakhstan. So CAVIE went into Kazakhstan, into e-commerce in 2013, but 2016, CAVIE was the number 1 e-commerce player by far. So they totally dislodged Alibaba. And so that's the attraction. So that business just, it's a very fast growing business. They grow earnings in dollars 40 to 50%. They have no debt. And of course, when we bought it, it was extremely cheap. We paid 5 times earnings and we got a 13% dividend yield. So, yeah. And what I noticed, and it's an interesting dynamic when it comes to those emerging markets, is that if you look, let's say, at the US, so the gap between the best business and the mediocre business in terms of management quality is not going to be that wide. So most people, whether you go to Harvard or you go to, like, I don't know, some tier 2 school, it's the same books, it's the same knowledge. So there's a very good sort of dispersion of the knowledge. However, if you go to Kazakhstan, what happens is you have your best team at CAVIE, and then the second best team is probably going to be like miles away in terms of quality. Like they just don't have any expertise at all. So, and with CAVIE, it's a bunch of Harvard grads. So they came to Kazakhstan, they were given the business, they said, look, what can you make of it? And they, studied what Alibaba did in China, they studied Amazon, PayPal in the US, and they came out with CAVIE, except for they said, look, we're just not going to do like a single funnel business, we're going to do a multi-funnel business. There is no reason for, I guess, PayPal, Amazon, and whatever else you have, there's no reason to have those separate funnels. They had the benefit of hindsight, so they said, look, we're just going to create an integrated super app. And of course, there is no more talent in Kazakhstan to even be close to challenging that. So there was this blank space in Kazakhstan, and they just took it over. Like there is just no challengers in sight.
At the beginning, you said you invest like a private equity minded. What does that mean?
Well, basically, we don't view ourselves as financial analysts.
Okay.
We don't necessarily spend too much time poring over financial statements, even though that's a factor. But basically, we ask ourselves a question: if we're to buy this business outright, would that be an attractive purchase or not?
Yeah, I have a question. So you mentioned this Mexican company, the return on tangible equity is like 30%.
30.
Is that same thing as ROE?
Well, ROE, I think it's return on total equity.
Okay.
And
So it's like return on investment.
well, no, it's a little different. So I guess it's the difference between return on tangible book and return on total book is the goodwill.
Okay.
So to the extent that I think normally if you have, if you made acquisitions, then that's going to be the differential between return on tangible book and return on total.
And for this company, I think the financial statements are in Spanish or something?
I mean, I'm sure that they have statements in Spanish as well, but like the one that I look at are English.
Okay. What if there's a company in a country that they don't have English version?
Well, then we probably wouldn't invest. But I'd say like most of the countries, like I'm yet to find a business that has no statements in English. Like I think most people understand that English is the language of business. So I suppose there are places where like there is no availability of statements in English, but for the most part, they're all in English.
Hello, Mr. Guest. First, thank you for your presentation. I was wondering, how do you manage currency exposure? And let's see, when you get a very good business, but when the business model has no impact had against local currency depreciation, what you are going to do at that time?
Okay, so the question is, how do we manage currency risk?
Yeah.
Okay, so I'm going to go back. Well, I guess I can't really go back. But, okay, so first off, we are US dollar investors. Our investors are all giving us US dollars, so they expect us to generate returns in US dollar terms. And so that's how we approach FX risk. So we normally look at businesses and would say, for a given business, are we able to buy those businesses where they have an implicit hedge against local currency depreciation within the business model? A couple of examples. Number one, there's a business in Turkey that we used to own, and they made building materials, and most of those materials were exported to Europe. So we just said, okay, a business like that, even though it's based in Turkey, there is no FX risk because it's an exporter, and they essentially sell in euros. There was a business like that in Brazil as well. Most of their sales were to Europe as well. And we said, for a business like that, there's no currency risk because there's implicit FX hedge within the business model. You can also look at a business like Genomma Lab, and I'd say for Genomma Lab, they also have an implicit currency hedge within the model. Like I mentioned, they sell products that are essential and low ticket in nature. So what happens is if there's local currency depreciation, they just automatically raise prices by the amount of depreciation. So net, there is no FX risk. But of course, sometimes you look at a business and there is no implicit currency hedge within the business model, and in those cases, we normally don't invest. One example would be if you look, let's say, at a utility business in Turkey or Brazil. So with businesses like that, if the local currency collapses, well, you won't be able to raise prices by the same amount as the currency depreciation, and therefore you're going to be facing currency risk. So businesses like that, I'd say that we wouldn't be too keen to invest in.
Thank you.
So you don't like to hedge yourself explicitly, right? You don't.
No, because it gets,
Expensive.
number one, it gets very expensive. Number two, you don't even know where the moving pieces are. It's never going to be perfect, right? Because for every business, you have so many moving pieces, like where do they buy their supplies, where do they sell. So it's just very hard to do it perfectly. So basically, so look, if there's an implicit hedge within the business model, then that's fine, we'll buy it. And if not, well, then we'll probably look for greener pastures.
Quick question, yeah. First off, thank you for coming here today. I had a chance to watch your video when you visited IB, so
Okay.
some of this sounds a little bit familiar, but yeah, you're an excellent speaker, so
Thank you.
My question here is, so you said you use your customers as a source for like insights or to use like their network. My question is like how important is it for your investors to have some level of insight that's useful or a network that you can use, or are you just comfortable picking anyone that meets like your investment requirements?
I would say that normally we want people who think like us. Like we've had cases where like I would talk to someone and just talking to them, I just got a feeling that they had no idea. Like they didn't mind writing a check, but I could tell that, for example, to them, risk was not permanent loss of capital. To them, risk was stock price fluctuations. And basically, I just refused to take money from them because I knew that that'd be probably more pain than it's worth.
Okay, so then assuming like you don't have like a cap of how many people or how much funds you want to hold, like you would take someone as long as they understand it and they're willing to invest the amounts like required.
Well, and it would also depend on what investment opportunities are available, right? If somebody were to show up today and say, well, here's $2 billion, well, is there enough investment opportunities today to allocate $2 billion? Well, if the answer is yes, then I would take it, but if the answer is no, I would not, because that would just, dilute the existing investors, and I guess I'm the single largest investor in the fund, so I wouldn't be diluting myself either.
Thank you.
Given your extensive experience investing worldwide, I'm very curious which geography region that you're looking into nowadays.
Well, the one that looks most interesting right now to me is China. So, and China is sort of a unique market in a sense because it has the depth and the breadth of various businesses. I think outside of the US, China is probably the only other market where you just have such a diversity of businesses. And they're all kind of like indigenous. So there's just tons of potential investment opportunities. Again, it might not be that all of them are cheap yet, but definitely like I see a lot of attractive investment opportunities in China. And actually, I think about 25% of our investments are currently in China.
What would you put as the sort of maximum limit exposure to China? It's already 25%.
I'd say we're probably not gonna go much more above than 25%.
Okay,
Maybe 30, but not much more.
thank you.
So you're not afraid that maybe they try to attack Taiwan and then the US get involved and there's a whole mess down there?
Well, I think it's a risk. I think it's a very low risk, but it's it is present. I think it's not would be inconsistent with the Chinese character to attack Taiwan. I think with the Chinese generally would just say, you know what, like I'm just going to grow enough muscle to where they're just going to give it to me, rather than trying to take it by force. I think they feel like time is on their side, and they feel like eventually they're just going to get it. So why risk it? And of course, like I think they've seen with Russia that on paper it might look easy, but in practice it's challenging. So
Anything about internal politics in China you're also looking into? Because it was always a 3 different country before, and the US allies also know China is a big threat going forward. And so, is there anything of that internal politics that you're looking into at all?
Like
in
I
China?
follow it, but I don't ascribe too much value to sort of just
Speculate,
being a Chinese politics tea leaves reader. I think as far as investments are concerned, that's mostly noise, but of course, I think I do keep track of that. And yes, like I understand that US sees China as a threat, but I think the question is, are they going to do anything drastic to address that? And I think given the strength of China and the fact that it's got the second largest GDP in the world, my bet is that it's unlikely. Again, not zero probability, but probably not a very high probability that the US are going to do something drastic that would impact investing. So would not necessarily expect to have a high probability of something similar to Russia happening, such that you get locked out of the Chinese market.
Thank you.
John?
Thank you very much for the presentation. My question is actually around, you're in some very interesting geographies. To what extent do you analyse and assess regulatory risk in those geographies before making an investment decision?
Sorry, to what extent we
assess and regulatory risk?
Regulatory risk?
Yes, so regulatory, legal, rule of law, those sorts of things.
Look, we always do it, and it really doesn't matter if it's an emerging market or a developed market. I've seen enough risk in developed markets when it comes to regulatory risk,
Yes.
sometimes more so. So, when people talk about, Turkey, they're saying, oh, it's just so uncertain. I'm like, well, look at the US. What happens if Trump gets elected? Like, isn't that going to be pretty uncertain too? So, but back to your point, like we always do it. We always assess the regulatory risk. We also assess the risk of those assets being confiscated from you. That can happen. I can tell you, for example, when we look at places such as like Russia or Turkey, and of course we no longer are able to invest in Russia, but way back in the day we managed to do it. We would basically stick with businesses that have some link to the state, so that that would serve as a protection of sorts from any kind of confiscation. So, as you know, that Russian company UCOS got taken away from the shareholders, and of course part of it was the fact that it was not a state-owned entity. But if you invest in a state-owned entity, well then you have protection from being taken advantage of, provided they run it in a sort of clean fashion. And again, like there's some nuance to it. A lot of times they create those structures, especially on the banking side, and I've seen it like in Russia or Turkey. They would have sort of your good bank and bad bank, and they would just say, look, one of those companies, state-owned, we're going to run in a very sort of Western fashion, and then you're going to have this bad bank where we're just going to like sweep all the bad loans into that business, and that's going to be run in a sort of third world fashion. And of course, this is something that we analyze and take into account while making investment decisions.
intuitively, how do you choose which emerging market to get into, and what is the next? Where do you see the next emerging market to go to?
Sorry, can you speak up?
So intuitively, how do you choose your which emerging markets to enter?
Well, it's not really intuitive. It's data driven. So we look at the valuations, and we look at the valuations versus the regulatory framework, the geopolitical framework, and to the extent that you're in a good spot valuation-wise, and in a decent spot with respect to the geopolitical situation, well, then we do it. So it's not really intuitive.
Thank you.
Good questions?
So you mentioned that this girl in Mexico who's like the sale for the fiber who you talked to. Like, how did you establish that connection?
How did I find her?
Yeah.
Well, I find those sorts of contacts in various ways. Sometimes it's just a cold call, sometimes it's a friend of a friend, but in that case, she was actually friends with a client of ours. So one of our investors is a Barcelona business school, and she went to Barcelona business school, and she knew people at the endowment, and they put us in touch.